All right, you put out a report a few weeks ago. You said the signs of a bubble are rapidly increasing valuations, high concentration, and also vendor financing. We're seeing all three, but then you go on to say it's not quite a bubble, at least not yet. So if we're seeing that already, why isn't it a bubble?
Well, there's an extent, I think, that we tend to see those factors playing out. And for sure, we've had a strong period of returns, particularly driven by tech stocks in the US. But the first thing to bear in mind is that that is not related to AI specifically. That's become the increasingly strong narrative. But actually, the tech stocks and the US market driven by them have been outperforming for 15 years, and that's been completely underpinned by extremely strong profit growth. So as yet, this dominance of these large companies and the tech sector in particular has really been based on fundamentals, not speculation or irrational exuberance about the future. So I think it's really supported by fundamentals so far. Of course, that could change as speculation builds, but I don't think we're in a bubble at this stage.
All right. So valuations are certainly elevated when we talk about the Mag 7 and a lot of these other names, but you say they're not technically stretched. How do we know when they're actually really stretched and pushed beyond what would be reasonable or make sense on a fundamental basis?
Yeah, so bubbles really tend to build up around narratives when you've got strong story that gets people excited, both investors and also companies that increasingly attracted to the space. And that pushes up valuations ultimately to a point where they're making an irrational claim on future potential growth. Now, clearly, tech has done very well, and the biggest stocks in the US are huge. The 5 biggest stocks in the US, the tech stocks, are around 16 or 17% of the value of the whole global stock market. But if you look at their valuation specifically, because they've been underpinned by very strong profitability, they're not really at the sort of levels we've seen in bubbles in the past. So, you know, if we take a PE, for example, over the next 2 years to avoid, you know, any distortions over a single year, on average, they're trading at around the mid-20s type PE. If you looked at the biggest 7 stocks, for example, in 2000 at the peak of the technology bubble, they were trading at around 50 or even a little bit higher than that. And they were not actually the most expensive stocks at the time. There are other bubbles that we can look at as well. Japan, of course, in the late 1980s, saw a bubble driven by real estate prices and banks. And again, their 7 biggest companies had much higher multiples than we're seeing today. So yes, we've seen tremendous performance, significant concentration. Those are potential steps towards a bubble. But because it's been underpinned so far by fundamentals and the valuations are high but not extreme, we don't think we're there yet.
Okay. Peter, you're such a sober voice on all this. We have such heated debates here on CNBC about all this. Why is everybody so worried about a bubble if there's no clear signs of it happening right now? It sounds like you're saying the potential's there, but right now there's no clear signs.
Yeah, look, let me be clear. There are some signs that we're getting to a point where excitement is building. And I think that's going to attract a lot more capital into the space and a lot more companies and competition. And we could get to a point where we get a correction. It wasn't that long ago, and people forget, when we saw the introduction, for example, of DeepSeek in China, that many of the biggest tech stocks did fall. They had a correction. The Nasdaq was down over 20% at one point earlier this year. But they recovered again as the fundamentals began to reassert themselves. So a correction is possible. I think not really, not really a bubble. Now, we are also seeing a massive ramp up in capex for these major companies, and that is a change. And there will be a question, I think, about what kind of future return they get on that capex, and whether indeed they are the companies that ultimately benefit most from that embedded infrastructure. And the history of technology suggests that while the technology itself may be transformational, other companies will probably come along and be able to leapfrog or benefit, if you like, from this embedded capex to generate new products and services. And that's really what we're what we're looking to happen as the market broadens out over the course of the next several months.
So, Peter, you continue to mention earnings as being kind of the underpinning for part of this rally, and one of the reasons why you don't really think it's a bubble, at least not yet. Are there other metrics that investors should be looking for to look at, I guess, the sustainability of this entire trade, whether it be margin? Does revenue actually matter, or is it just about profitability?
Yeah.
Because I don't know if you're watching the other part of the show. We hit on a number of companies doing workforce reductions. Ultimately, I'm sure there's some connection to AI and increased productivity, leading to them believing, at least for now, that they don't need as many workers.
Yeah, and again, very typical of what we found in many other waves of technological innovation through history. I mean, part of the key driver of technology is to improve productivity and find ways of substituting technology for labour. And as those technologies evolve, new products and services emerge which create new job opportunities. And that's what we're hopefully going to see. But look, what we have seen is a massive ramp up in capex in these companies. That's the signs that they're beginning to potentially hit peak margins and returns. But what we haven't yet seen is a vast increase in debt and equity financing. Now, if you look at many historical bubbles, the excitement around them really brings in huge amounts of new capital, and existing companies borrow a huge amount, both in terms of credit and in equities. You know, in the year 2000, for example, there was something like 500 IPOs in the tech sector in the US, and we've seen just a handful of IPOs this year. And these companies are ramping up their capex, but they're doing that mainly so far out of cash flow. So capex to cash flow ratios are still quite moderate. So we're looking at more of that kind of financing, and as you mentioned earlier, signs of increased vendor financing coming through. And you know, potentially this will generate more excitement in the sector, more adoption from other companies in other industries, and it could well be that we end up in a bubble, but I think we haven't got the signs of that kind of exuberance broadly in the markets just yet. And perhaps the final point to mention about this is that despite this intense focus on AI and the big tech stocks, actually this year our theme of diversification has really been playing out. Most markets, most regions around the world have had very similar returns in equities this year, even those regions that have very little exposure to technology. And we're also, because of this increase in capex, starting to see sectors in other parts of the economy benefit as you get a ramp up in infrastructure spend on energy, exploration and distribution, for example. And I think that broadening out in a way is relatively healthy.
Well, Peter, that's leading me to another question to you. Does it actually matter if it's a bubble for most investors? Most investors are index investors. Does this really only matter to people who are single stock investors who are pouring a lot of money in these individual names if it's a rising tide that's raising the entire economy?
Well, it's a good question, Frank. I think it does matter, and it matters because of the scale and size of these dominant companies. So index investors, of course, are very exposed to the areas that have been performing best. That's one of the great advantages, in the sense of being in an index. But if you think about it, the US stock market has been consistently outperforming others, really since the collapse of the financial crisis back in 2008-9. And that's largely been driven by technology, which has got bigger and bigger in the US index. And of course, the biggest stocks have almost record concentration. You know, the 5 biggest tech stocks in the US make up almost roughly a quarter of the index. So if they were to fall, if something was to go wrong, it would have a big impact on the broader index. In fact, indeed, that happened earlier this year, as we started to see a temporary derating in some of these dominant companies because they're so big. The US broader index did come down. And that's, again, another reason for staying invested, but to have a broader exposure, to look beyond just the dominant companies in this ecosystem around AI, to look at other regional markets and indeed other sectors that could benefit from this increased capital spending around the technology theme.